Okay, good morning. Welcome to the third installment of the Point View webinar series. Today we're going to be talking about annuities. I'm Claire Toth. I'm the Vice President and Planner here at Point View, and I'm joined by David Dietz, who is our President and Chief Investment Officer. And as we're waiting for, give people a moment to join us, we're just going to go over a little bit about Point View. I suspect most of you know this. Here's the team. Point View has been in business as an independent RIA since 1993, almost all of that time here in Summit, New Jersey. We're independent RIAs, fee only. We invest in individual stocks and bonds. We've been recognized by the media, by our colleagues for the hard work and good results we've had over the years. Before we get into the meat of this presentation, I want to point out a couple of things. David and I will be chatting back and forth for a while, but there is a chat box for you to ask questions. So please don't be shy. If something occurs to you, ask us a question. We'll get to as many as we can. Second, there's a poll that we've included, just a couple of questions, yes, no for you. We'll go over those at the end. And now I think it's time to begin the meat of the process. We're talking about annuities. And this is one of these things, everybody thinks they know what an annuity is. But it, like health or value or a few other things, it covers a broad range of ideas. You need to drill down to talk about what you specifically have in mind. With annuities, there tend to be two kinds. One is what we think of as a fixed annuity. It's akin to a pension. You give the insurance company a pot of money and you get an income stream for life. That may be for your life, for the life of you and your spouse. There may be a 10-year guaranteed payout, but at the end of the day, the pot of money is gone. Second is a variable annuity, and that's sort of like a do-it-yourself retirement plan with an insurance wrapper around it. And the insurance provides you'll get back at least what you put in. But to start putting some meat on these bones, I'm going to turn this over to David. So David, why don't you talk a little bit more about what an annuity is?
Thank you so much, Claire, and welcome all. So, an annuity is just another investment. It's provided by insurance companies, and it's designed to grow your money and pay it out on a regular basis until you die. Annuities may have an accumulation phase where the premiums you're depositing with the insurance company are invested to grow. They could grow either in a variable fashion, invested in equities or the like, or more in a fixed fashion, invested in bonds. So then you have the accumulation phase, and then later on you can turn on the so-called distribution phase. What this does is annuitize the amounts then in the annuity to pay it out periodically until the rest of your life, or the second to die of you and your spouse. So one advantage to an annuity, of course, is very much like an IRA, where the annuities, the earnings on the annuities are tax sheltered, not subject to tax until paid out.
I just want to chime in that when we talk about annuities having an accumulation phase before the distribution phase, that's typically the variable annuity. It doesn't have to be, though. It's possible to buy a fixed annuity that will begin paying out 10, 20 years down the road. The risk there, of course, is if you don't live those 10 or 20 years, there may be no payout whatsoever. And that's a good way to lead us into some of the catches with annuities. So, David?
Sure. So, it all sounds good. You got guaranteed returns. It's supposed to be without risk. It sounds simple. So let's do a dive into where some of the pitfalls might be. The first pitfall that we see all the time is a potential client or someone we know says, look at this fancy yield or return that I'm getting on my annuity. and we look at it in 6, 7, 8, 9%. But once you investigate what it's all about, you realize it's very misleading, because what's happening is you're getting periodically not just interest on your money, but also a return of your very own principal. So, let's just look at an example. I looked up my age, 62. If I bought an annuity for $100,000 and the website say I'm going to be getting $6,300 a year, 6.3%, I'm saying to myself, gee, wow, that looks so much better than a CD. That looks better than a 10-year government bond. The problem is that when you do the math and you take your life expectancy of 20 years, when you separate out the return of principal, you're only getting an annual rate of return of 2.3%, which actually does not look good on a 20-year investment. So that's the first thing you need to recognize, your first pitfall in terms of analysis.
And another simple way to look at this is if you buy an annuity that costs $100,000 and pays out the $63.12 a year, essentially for every $1,000 of annuity that you're receiving, you're buying in at a cost of $15,840. That alone can often cause people to pause. So
let's just talk about the second big pitfall. People often, say, gee, I love how this annuity sounds. And we'll go to them and say, well, have you maxed out on your 401k or 403b at work? Have you maxed out on your opportunities to fund an IRA? And they say, well, why should I do that first? Quite simply, both annuities and other tax-sheltered accounts, either offered via an employer or a rollout from an employer in an IRA, those also are tax-sheltered. There's a big difference. On the annuity, you're going to pay an annual fee, which can be quite high for insurance. It's called a so-called mortality fee. That's going to weigh down on your returns, but you don't have to pay that in these other tax-sheltered vehicles. On top of that, you can pay high fees if you decide to exit the annuity early. And of course, often your investment choices are limited, while typically in, let's say, a rollover IRA, you've got every investment choice under the sun. So pitfall number 2 is to fund or buy an annuity before maxing out on other retirement plans.
And the tax lawyer in me has to point out, particularly here, we're talking about a variable annuity, which is a retirement plan kind of substitute. The variable annuity, as we'll get into, has less favorable tax provisions when you get to the distribution phase. Number 3.
Sure. So another pitfall when analyzing whether you should buy an annuity is not focusing on the very high fees that are typically associated with them. So, they say annuities are not bought, they're sold. And the person selling you that often is very well compensated because it's a complicated, difficult sale. That can be as much as 5 to 6% commission on the principal of your investment, and could be as high as 8%. And how does that factor in? Well, they make that payment to the insurance salesperson right up front, so they can't have you leave too quickly. Otherwise, they have to recoup what they just paid out to the insurance salesperson. So often, you have to wait up to 8 years to sidestep a so-called back-end fee, because that's what the insurance company paid the salesperson, and that's also known as the surrender fees. On top of that, as we just talked about in the last slide, in order for it to count as insurance, there must be an insurance component to it. That's paid for by so-called mortality fees. They can often be 1.3% or more per year. What does that do for you? That gives you, upon your death, the greater of your original deposit or the current value, but we're always left scratching our head, well, how does that help you in retirement? If it's a 20-year investment, just getting back what you put in 20 years ago does not sound particularly enticing.
And I do want to point out that the mortality fee also, or the insurance component, takes into account distributions. So it's not just that you'll get back when you put in, it's what you put in, you'll get back what you put in minus what you've already taken out. Next pitfall.
Sure. So often we see someone show us their account statements for analysis, and we see an IRA and an annuity held within the IRA. For some reason, people like to buy annuities in their IRAs. And, one of the attractive features, admittedly, of the annuity is to allow your money to grow tax deferred. But if you're buying it within an IRA, the IRA already offers that feature under the tax law. All your profits in the IRAs are also tax deferred. So you're doubling up on your tax deferral. You've got a belt and you've got suspenders. The problem is the suspenders also are very expensive. So it's kind of wasteful. So we always caution investors to avoid, if you're going to buy an annuity, don't buy it in an IRA or other qualified account.
And we typically see this occur in 403B accounts. These are employer retirement plans offered in the nonprofit and public sector. So if that's where you work, take a close look at your retirement plan. Be sure that you're invested in something other than an annuity.
So pitfall number 5, failing to consider an annuity's lack of liquidity. As an investment professional, all things being equal, you want liquidity in your investments. The future is always uncertain. You never know when you may need a spending need. You may wish to go in a different investment. And the ability to be able to pivot and turn is important. But unfortunately, annuities are not particularly liquid. So for example, if you buy an annuity subject to surrender charge, that charge could be imposed anywhere from 5 to 10 years after purchase. And so any kind of a withdrawal of more than 10% of the account will incur those surrender fees. That is a big impediment to liquidity. It's a little bit like trying to exit a CD before it's matured. But unfortunately, the penalties are far more severe than exiting a CD prematurely, which can be up to 8% of the amount withdrawn. On top of that, any kind of premature withdrawal from an annuity has adverse tax consequences. Normally, you like to withdraw your principal first from an investment and your profits later, but this is turned upside down when you make a premature distribution of an IRA. The profits come out first. They're not deferred, so you accelerate taxes, which is not good. On top of that, annuities often are subject to a penalty of 10% of your profits if you make your withdrawal before age 59 and a half. This is very analogous to a premature IRA withdrawal. And of course, once you annuitize, let's say a variable annuity, and you're in the distribution phase, further acceleration of withdrawals are not permitted at all.
So I just want to put a couple of these pieces together. If you're before 59 and a half and you need the cash, you need to take some but not all of your investment out of an annuity, what's going to come out first is the profits. So you're going to be taxed on ordinary income plus a 10% penalty on the profits. And what's left behind is the initial investment, which under other circumstances could come out tax-free. Number 6.
Okay, number 6.
More taxes.
Yeah, exactly. So, what they say in the investment business is not what you make, it's what you make after paying Uncle Sam and Trenton if you're in New Jersey or wherever your state capital is located. And unfortunately, annuities are subject to high tax rates on distributions. So you are not able to defer taxes until the end of the policy, but you have to pay when they are received. Now, there's really 2 types of tax rates to simplify the taxation of investments. One are taxes on long-term capital gains and taxes on qualified dividends. Qualified dividends are just about all dividends paid from stock. As a general proposition, long-term capital gain profits and qualified dividends are taxed at half your ordinary income rate. Ordinary income rate is basically what you pay when you make one more dollar of salary or consulting income. And so that is a big penalty because you're paying almost twice the taxes on your profits. And of course, on top of that, if you don't annuitize the distribution, in other words, you take one-off distributions, all the profits come out first. So not only do you accelerate the tax, but again, you're paying taxes at ordinary income rates.
Okay.
Pitfall 7. You always want to consider the impact of inflation on any investment. Now, we've been through a low inflation period, but some of us remember the 70s when inflation was marching along at a double-digit rate. And that really harms the real return on your investment. So annuities periodic payments are typically fixed. They can be analogized to a private pension where you get the same amount month in and month out until you die. But of course, if there's inflation, each succeeding payment actually buys less and less. Now, insurance salespeople will tell you, well, just buy one of our inflation riders, and so the payments will go up with the inflation experience. The problem is that protection is normally capped to inflation at just 3%. Well, if inflation is just 3% over the next 20 years, we're all going to be in good shape. And I think we, given federal deficits and other runaway spending, must be prepared for inflation to be much higher than that. Now, it is true that in an accumulation phase, if you invest your money in the stock market or other type of variable annuity, you may have a better chance at offsetting inflation during that accumulation phase. But of course, that depends on how those underlying investments do. And of course, is the fees that are paid on those underlying investments must be subtracted from your ultimate return.
Okay. And just to chime in with the inflation rider, if you do buy it, there is an annual charge for the inflation rider, and that's going to reduce either what you're earning or what you're receiving in your payout from the get-go.
So the next,
my favorite,
the next pitfall really is, buying an annuity. What does that do for your loved ones in the next generation? And so annuity can generally be analogized to a pension. You enjoy it during your retirement years, but when you pass away, or perhaps when you and the second to die of you, if you're a couple, that's it. The next generation has nothing. Once you pass, there's nothing left. Now, while no one's going to turn down a pension from their employer, if you're initiating an investment, why would you opt for something that will be worthless upon your passing? If you can get great returns from a balanced portfolio of perhaps stocks and bonds, when you pass away, the next generation has something to work with, which is nice.
Okay. And even while you're still around, you have to start taking money out at some point. Here you are.
So, an annuity is a little bit like a timeshare or, a Roach Motel. Once you get in, how the heck do you get out? It is not easy. First of all, if you already own an annuity, you have to see what the back end fees are. They can be tremendously onerous, up to 8% subject that are applicable during the first 8 years of your purchase of that investment. And of course, that's to pay the salesperson. Tax consequences. If you've got a buildup of unrealized appreciation, if you liquidate early, you're going to have to pay the tax person. And so that can be an impediment to getting out of the annuity and must be analyzed carefully. If you're outside a tax shelter account and you're investing your annuity using non-qualified monies, not in an IRA, you need to check to make sure you're not subject to a penalty on your profits for withdrawing before age 59 and a half. After exiting, what do? Our recommendation would be having a balanced, diversified portfolio of stocks and bonds. The stocks historically have provided great growth, while the bonds will serve to dampen volatility and provide some income.
Okay, and if you don't like the annuity you're in, but you are under age 59 and a half, or there are some profits in there you don't want to recognize, there is the possibility of exchanging the annuity you have for another annuity on a tax-free basis. There are companies some companies with much less expensive annuities. And that's something that you or we can help analyze and see what range of alternatives there are. What we don't have in here is what happens. This is more the variable annuity. It's a question that we've seen about what happens if you inherit one of these. If you are the surviving spouse, typically you can treat the annuity as your own, much as you could with an IRA. If it's the child who's inherited a variable annuity, if the annuity's already in an annuitized payout phase, the child is going to step into the parent's shoes and keep taking those monies out. If the annuity has not begun paying out yet, then you've got some options, and none of them are really great. You can take the child can take a lump sum payout, can take a full payout over the course of 5 years, or the child has 60 days to elect to annuitize over his or her own lifetime. And I want to contrast especially that last one if the child is a beneficiary on an IRA or an employer retirement plan. With a qualified retirement plan, the child has typically until September 30th of the year after the parent passes away to make that choice. Those of us who have lost a parent know that 60 days can be a really short window, not only to make decisions about what to do, but to figure out what all assets are out there, who's got them, what they're worth. And if it's very easy for that 60-day window to pass in the annuity situation without the child even being aware of it. So even with an annuity that leaves something for the next generation, you can serve the next generation better. So we're going to look at some of the questions we've been asked, but I want to remind everybody that we've got this little poll to look at and vote. We'll let you know what happens at the end of this. Okay, here's a question for you, David. I like the monthly cash flow I receive from my annuity. How do I replace that income if I exit the annuity?
Yeah, it's a great question, and we get it all the time. Basically, people are saying, gee, one of the reasons that I got into an annuity is to replace the paycheck that I enjoyed during my working years. And with, today's low interest rates and relatively low rates for dividends, how can I replace that big, juicy annuity monthly payment, which, as we talked about earlier, includes a large portion of principal? And so what our answer to our clients is to basically create your own income stream that's paid to you on a monthly basis in an amount that's going to work for you. We analyze quite carefully what stocks should do over the next 20 years, what bonds should do, what cash should do, and we don't limit ourselves just, for example, to the dividends paid out on stocks. We look at the total return. And then on a regular basis, what you would do on your own, or if you worked with an advisor, you would basically trim, nip, and tuck at various portions of the portfolio to supplement the income actually paid out so that you would be able to make that distribution in the requisite amount on the correct day. Now, some people say, well, isn't that as bad as the annuities where you're basically getting a repayment of principal? No, not at all, because what we're doing is tapping into the total return of the stock. And we're not diving into principal, but looking in basically tapping into the portion of earnings generated by the companies in your portfolio that's not paid out as dividends and therefore is retained and helps push up the value of the stocks. So that's how we would do it.
Okay. How's this one? Because it's people with the 10th anniversary of the 2008 crash, what happens to an annuity if the market does that again and drops 30, 40, 50%?
Yeah, so that's a great question. I mean, it really depends to start with what type of annuity you have. If you've got a variable annuity, which is tied to the stock market, obviously the value of that annuity is going to drop dramatically. You're also going to be facing, if of course you're in a fixed annuity, you shouldn't have any problem. But of course, that would be analogous to having a fixed income portion of your portfolio that hopefully holds up. There's a big difference, though. If you have a safe portion of your portfolio in fixed income, if you want to, you could exit some of that and take advantage of perhaps mouth-watering opportunities. On the other hand, with the annuity, because of the liquidity, lack of liquidity, as we discussed earlier, you're locked in. You can't take advantage of what might be a great opportunity. Obviously, both annuities are typically for the long haul. Balanced portfolios of stocks and bonds are for the long haul. So we really basically look at not a point in time where the market is, but where the market is supposed to be over the next 20 years. That's the advantage of the stocks and bonds, because they've historically grown dramatically, while the annuities, burdened by higher fees, have a much lower growth potential.
Well, and David, the other point with the fixed annuity in a down market, the insurance company is guaranteeing you the same monthly payout. And that means that your risk is really with the health of the insurance company from whom you bought the annuity. We've seen insurance companies go under. Typically, somebody else will bail them out and pick up their obligations, but that's not a sure thing. So you need to be very careful who you're dealing with if you're contemplating an annuity.
Claire, that's a great point. The word guarantee, it sounds good, but remember, it's not the guarantee of the federal government. It's not an FDIC guarantee. It just means that the insurance company has an obligation. It's a little bit like taking out a mortgage on your house and saying, I'm guaranteeing the repayment. That guarantee is only as good as your ability to make those payments. So it's a tricky word. It sounds comforting, but we've seen in the past that insurance companies get into trouble. So just like in a stock and bond portfolio, you would diversify carefully each of the companies and entities you're exposed to. With annuities, you ideally would want to, if you're going to go in that direction, have annuities from many different companies and not just put all your eggs in one insurance company's basket.
Great. Believe it or not, we seem to have a fairly incurious audience here. So I'm going to flip us over to our poll. And we happen to have about our audience is about equally divided between folks looking to exit their annuities and folks thinking about investing in annuities. So maybe there's a way to get all these people together and they can start swapping their annuities around. What do you think? But
that's what makes the market, of course. But certainly, we've actually seen situations where there is an onerous surrender fee, but each year it steps down by 1%. And we've seen situations where the internal fees can be 2% or more. So people say, well, I got a surrender fee of 7% for the next 7 years. I guess I'm locked in. Maybe, maybe not. Maybe you just bite the bullet, because over the next 7 years, you're going to be paying 2% per year on internal fees. That's 14%. So you decide, I don't want to pay 7%, but over the next 7 years, I'm willing to pay 14%. It's a very tricky analysis, but you have to look at all aspects of it.
Okay. Nothing simple. And thank you, everybody, for joining us. We look forward to sharing our next webinar with you in the next couple of weeks.
And I would like to say one thing, that if you missed any portion of this presentation or would like to see it again, we will get a replay to all those participants who signed up to hear it. So don't worry, you'll have another second chance. Thank you so much.
Thank you all.